Recording in progress.
Good morning. Good morning. Good morning, class. Good morning. Hello. Good morning, class. Good morning. So today we shall be looking at personal income tax. We shall be looking at personal income taxation today. That is our topic, personal income tax. We talk about personal income tax today. We are going to look at what is personal income tax. How do we compute personal income tax? What are the income subjected to personal income tax? What are the income exempted from personal income tax? So what are the bases of computation of personal income tax? All this will be discussed under personal income tax. Like I said last week, personal income tax is a form of direct tax. It's a direct tax that deal with assessment and collection of tax from individual, partnership, executors, trustees, communities, and corporate entities. Personal income tax is a tax imposed on income derived by individual, sole proprietorship, trustee, partnership, and community. Personal income tax is otherwise called pay as you earn. So an employee every month from his salary, as they are paying employee salary every month, his salary will be they will deduct personal income tax from the employee salary. So they will deduct personal income tax from employee salary. So personal income tax is called pay as you earn. And the personal income tax is regulated by Personal Income Tax Act 2011. The next thing is, who are the persons liable for personal income tax? Who are the persons liable for personal income tax? The persons liable for personal income tax. Under Section 2 of Personal Income Tax Act 2011 as amended, the following persons are liable to personal income tax. Number one, individual. Individual. Individual means self-employed individual. Somebody that is not under paid employment, that is under his own personal trading or personal business, or is rendering his own professional business, professional service. They are self-employed individuals. So they are the first category of persons liable to personal income tax. Another persons liable to personal income tax is sole proprietorship, sole proprietorship, sole proprietorship. The owner of a business called sole proprietor, one-man business, is at the end of the day, from his profit, is going to pay personal income tax on his profit. Another person's liable to personal income tax is partners in a partnership business. Every end of the year, the profit derived by the partnership business is going to be shared among the partner. Once the partners share that profit, in the hand of each of the partner, they are going to pay personal income tax on the profit that they receive. Another person's liable to personal income tax is trustees. Trustee. Trustee simply means somebody that is appointed to manage the business or the asset or the estate of a deceased person. An appointed administrators that's responsible for the management of the business or asset of a deceased person. That person is called trustee. Is also liable to personal income tax. Another person's liable to personal income tax according to Section 2. A member of Nigeria Armed Force, a member of armed force personnel, such as Nigeria Police, Nigeria Navy, Nigeria Army, Nigeria Air Force. They are also stated, according to the section of Personal Income Tax Act, that they are liable to personal income tax. A resident of Federal Capital Territory, FCT, a resident of FCT is also liable to personal income tax. A resident of FCT, they are also liable to personal income tax. Non-resident individual. Non-resident individual is also liable to personal income tax. Non-resident individual. Who is the non-resident individual? Somebody that does not reside in Nigeria for more than 183 days. That person is also expected to pay personal income tax. So under individual, we have a person called itinerant worker. Who is an itinerant worker? Itinerant worker is an individual that is under paid employment or is under wages that work in a particular year of assessment. He work in more than one place. That means in a particular year of assessment, he work in different states. That person is an itinerant worker. Somebody that is under paid employment or under wages that work in more than one place of residence. Because personal income tax is based on place of residence. What I mean by that is how you pay your personal income tax. The tax authority responsible for collection of personal income tax is State Board of Internal Revenue. And as an individual or employee or partnership, if you want to pay your personal income tax, we are going to determine your place of residence. You are going to determine your residence. So personal income tax is based on residential rule. What we mean by that is where you reside, the tax authority that is situated in where you reside is where you are going to remit your personal income tax to. Take, for instance, you are residing in Ogun State, but you are working in Lagos. If you want to remit your personal income tax, you will remit it to Ogun State Internal Revenue Service, not Lagos, because you are working in Ogun State. You remit it to Ogun State Internal Revenue Service, not Lagos. That is place of residence. Personal income tax is based on residential rule. It's not based on income rule. Income rule means where you derive your income, that is where you are going to remit your personal income tax. But in the case of residential rule, where you receive, where you are residing, that is where you are going to remit the personal income tax. So personal income tax is based on residential rule. So where you reside is where you are going to remit your personal income tax. Now, another thing that we are going to look under this personal income tax, what are the other things that we need to look? We need to look at, we have discussed itinerant worker. Itinerant worker means an individual or a person that in a particular year of assessment, he earns wages, but he resides in more than one state in a particular year of assessment. Now, under personal income tax, what are the type of individual that we have under personal income tax? What are the type of individual that we have? Under personal income tax, there are two types of individual. Number one, resident individual. While number two, non-resident individual. Resident individual and non-resident individual. Resident individual, what do we mean by resident individual? Who is a resident individual? Resident individual is otherwise called Nigeria resident. Resident individual is otherwise called Nigeria resident. Resident individual is an individual that resides in Nigeria or domicile in Nigeria for more than 183 days. An individual that resides or domicile in Nigeria for more than 183 days, and a Nigeria citizen serving as a diplomat in another country. A resident individual. You may be asked, who is a resident individual or who is a Nigeria resident? It's the same thing. Nigeria resident is also called resident individual. So it's a person that domicile in Nigeria for more than 183 days. And a Nigeria citizen serving as a diplomat in another country. What we mean by that is you are a Nigeria citizen. You are a citizen of Nigeria by birth. Your parents are from Nigeria. You are now working under Ministry of Foreign Affairs. They now transfer your service to other country to go and be working in Nigeria embassy in other country. While you are working in Nigeria embassy in other country, you are still a Nigeria resident. You are still a resident individual in Nigeria. Your personal income tax will still be remitted to Nigeria government. Your personal income tax will still be remitted to the tax authority in Nigeria. So, personal income tax of a resident individual will be remitted to tax authority in Nigeria. Who is a non-resident individual? A non-resident individual is an individual that does not domicile in Nigeria. It does not domicile in Nigeria for more than 183 days, but derive income in Nigeria. An individual that does not domicile in Nigeria for more than 183 days, but derive what? Derive income in Nigeria. And a foreign citizen serving as a diplomat in Nigeria. I've defined resident individual. Under resident individual, I said is an individual or a person that domicile in Nigeria for more than 183 days and a Nigeria citizen serving as a diplomat in foreign country. I want to define non-resident individual. I want to define non-resident individual. Like I said non-resident individual is an individual that does not domicile in Nigeria. That means it does not stay in Nigeria for more than 183 days. An individual that does not domicile in Nigeria for more than 183 days, but derive what? Derive income in Nigeria. That person does not stay in Nigeria for more than 183 days, but that person now derive income in Nigeria. And a foreign citizen that is serving as a diplomat in Nigeria, those who are working in foreign embassy in Nigeria, that they are working in American embassy, they are working in UK embassy, they are working in France embassy that are in Nigeria, those foreign citizens working in those embassies, they are non-resident individuals. Their personal income tax on their income that they derive from working in foreign embassy in Nigeria will not be remitted to Nigeria government. It will be remitted to their to their country of origin. It will be remitted to their what? Country of origin. So that is on resident individual and non-resident individual. Now, let's look at relevant tax authority for personal income tax. Who are the tax authority responsible for personal income tax? The relevant tax authority for personal income tax is the State Board of Internal Revenue Service. State Board of Internal Revenue Service, where the employee reside, or where the partner reside, or where the trustee reside. So the relevant tax authority for personal income tax is what? State Board of Internal Revenue Service. Example of State Board of Internal Revenue Service: LRS, Lagos State Internal Revenue Service; OGRS, Ogun State Internal Revenue Service. All these are the State Board of what? Internal Revenue Service. So personal income tax is based on residential rule. The state that you reside is where you are going to remit your tax to. Now, let's talk about place of residence. Place of residence. What is place of residence? Under personal income tax, we say personal income tax is based on place of residence. That means the place that you reside, which indirectly means the state that you reside. That is where you are going to remit your personal income tax to. Now, what is place of residence? Place of residence in relation to individual. Place of residence in relation to individual means a place available for his domestic use in Nigeria on any relevant day. Place of residence does not include what? Any hotel, rest house, or other places at which is temporary lodging, unless there is no permanent place is available for his use on that date. Place of residence in relation to individual simply means that place that is using for his domestic use in Nigeria, which means that is that person is sleeping, is waking up, is doing his daily the personal routine service.
Your place of residence simply means the place that you rented, that you normally sleep, that your family is located, that you normally do you normally eat. You understand? That you normally put your personal belonging, that you normally use as your house address. So under taxation, under personal income tax, place of residence in relation to individual means a place available for his domestic use in Nigeria on any relevant day. Place of residence does not mean hotel. When you are staying in an hotel, you cannot call hotel a place of your residence. You must have, apart from that hotel, you must have a place that your family is residing. Maybe your wife and your children is residing. You just come to Lagos to come and work. They transfer you to Lagos. You don't want to rent an apartment because of the expensive of getting an apartment. Now say, let me lodge in an hotel. When you lodge in an hotel, that hotel is not your place of residence. Or you have a restroom. That restroom is not a place of residence. Unless you don't have permanent place of residence. You don't have permanent place. You don't have, maybe you don't have any family. You are married, you are still single. So you don't have any family. You just got an appointment, you just get a job, and you have not gotten a rented apartment. You now say, let me be staying in an hotel for a while. That hotel you are staying, since you don't have permanent place, can be referred as your place of residence. Now, what are the type of residence that we have? What are the type of place of residence that we have? What are the type of place of residence that we have? Type of place of residence. What are the type of place of residence that we have? What are the type of place of residence? There are two types of place of residence. There are two types of place of residence. We have single residence. We have dual residence. Single residence simply means you have one place of residence. You have one rented apartment, or you have your one personal house. But dual residence simply means maybe you are so rich and you now build an apartment in more than 3 different states. That means you are a dual resident. You have a building, you have an apartment that you build, your own personal apartment in more than 3 different states. That means it's a dual residence. A dual resident individual is an individual that have more than one place of residence. An individual that have 2 or more place of residence in Nigeria. You have house in Oyo State. You also have house in Lagos State. You have house in Ogun State. That means you are a dual resident. That is dual resident individual. When you have more than one place of residence in a particular year of assessment in Nigeria, you are a dual resident. Now, if an individual has a dual residence, if an individual have a dual residence, how do we determine where we are going to remit his personal income tax to? An individual that have a dual residence, that individual he has a building in Ogun State,
he has a building in Lagos, he has a building in Oyo State. How do we determine which tax authority, which state board of internal revenue service will collect the personal income tax? How do we determine that? Which state of internal revenue service will collect the personal income tax? How do we get that? How do we get that? So how do we get your principal place of residence in the case that you have more than one place of residence? How do we determine your principal place of residence? When an individual have a dual residence, when an individual is a dual resident individual, for us to get where we are going to remit his personal income tax to is for us to determine his principal place of residence. When an individual has more than one place of residence, individual is a dual resident. If we want to determine where we are going to remit his personal income tax to, which tax authority are we going to remit his personal income tax to? That means we are going to determine his principal place of residence. So his principal place of residence will be determined. In the case of somebody receiving pension alone, his principal place of residence will constitute his usual residence. His principal place of residence will constitute his usual residence. Out of those three places, he normally reside most. That would be his principal place of residence. That would be his principal place of residence. Out of those three places that that person is residing, which one the person normally reside most? That would be his principal place of residence. In the case of employee under employment, how do we determine the case of employee will be shown is nearest to his place of work? Now, let's talk about employment. Let's talk about employment. Let's talk about employment. Before we talk about employment, we have to go to this format first. Let's go and look at the format on how we compute personal income tax. Let's go and look at the format. This is the format on how we compute personal income tax. This is the format. For this format, if you want to compute personal income tax, you are going to divide the income of that individual, that employee, that sole proprietorship into two: earned income and unearned income. Earned income and unearned income. Earned income simply means income derived from trading or employment activities that involve physical and mental effort. Earned income simply means income derived from trading or employment activities that involve physical and mental effort. Example of earned income: salaries, basic salaries, housing allowance, transport allowance, utility allowance. Transport allowance. Transport allowance. Benefit in kind. Benefit in kind. All these are examples of earned income. Adjusted profits from trading in the case of sole proprietorship. They are all examples of earned income. Unearned income. What do you understand by unearned income? Unearned income means rents. Unearned income simply means investment income. Investment income, income derived from investment activities, such as rents, dividends, interest, royalty, etc. They are all unearned income. Income that you derive from investment activities, such as rent, interest, royalties, dividend. All these are unearned income. When you want to compute personal income tax, you are going to divide them into two: earned income and unearned income. Earned income and unearned income. Earned income and unearned income. When you sum earned income and unearned income together, you are going to get total income. Earned income, we divide earned income into two: employment income and trading income. Earned income, we divide it into two: employment income and trading income. Employment income is assessed to tax on actual year basis, while trading income is assessed to tax on preceding year basis. Example of employment income: basic salary, housing allowance, benefit in kind, transport allowance, utility allowance, pension, gratuity, meal allowance, employment bonus. They are all employment income under earned income. They are assessed to tax on actual year basis. That means
employment income that you derive in 2024 will be assessed to tax in 2024. Still under earned income, trading income under earned income, which is the second income under earned income. That one is assessed to tax on preceding year basis. Example of trading income: profit from business after capital allowance is assessed to tax on preceding year basis. Trading income is assessed to tax on preceding year basis. Is assessed to tax on preceding year basis. So we have two types of earned income, like I said: employment income, trading income. Employment income: salaries, benefit in kind, pension, gratuity, housing allowance, transport allowance, utility allowance. They are all assessed to tax on actual year basis. But in the case of trading income, which is under earned income again, which is second part of earned income, that one, example of that is business from profit after you have less capital allowance. That one is assessed to tax on preceding year basis. We have talked about earned income. Let's talk about unearned income. Unearned income, like rent, interest, royalty, gross. Unearned income, they are income that you derive from investment activities, and they are assessed to tax on preceding year basis. They are assessed to tax on preceding year basis. What we mean by that is earned income of last year, earned income of 2023, unearned income of 2023, sorry, unearned income of 2023 is going to be assessed to tax in 2024. That is preceding year basis. Rent that we derive, that individual derive in 2023, will be assessed to tax in 2024. Interest received by individual in 2023 will be assessed to tax in 2024. All this unearned income, they normally attract withholding tax. Before you receive earned income as an individual, they will have deduct withholding tax. So if you see this earned income, we are writing them gross. We write rent gross, interest gross, royalty gross, dividend gross, dividend gross. Anytime we are computing personal income tax, all those unearned income that attract withholding tax, we normally state them in gross. We state them at the gross amount. Gross amount simply means the amount before they deduct withholding tax. Example, let me give an example. A rent, you receive a rent. That rent on your property, every year, that rent is supposed to be 100,000 naira. When your tenant want to pay you the rent on that property, he's supposed to pay you 100,000. That means that is the gross amount. But since rent attract withholding tax, if your tenant want to pay you that rent,
he will deduct 10% withholding tax. If you that tax amount from the gross. But why they are computing your tax, they must show the gross amount. If you want to compute your tax, you will show the gross amount. You will not show the net. Though it's the net after they have deducted withholding tax that you actually receive. So it's the net that you receive. But while we are computing personal income tax, we show the gross. Anytime a question gives us net amount, we must report it in what? In gross. We must show the gross. Anytime we are giving net amount, we must show the gross. But if we are giving in a question, if we are giving gross, we don't have problem. We have to report. We have to write the gross amount. But if we are giving a net in a question, we must convert that net to gross. So we must convert the net amount to gross. Earned income on earned income. Anytime you are computing personal income tax for employee, sole proprietorship, individual, self-employed individual, you will divide the income of that person into two. Earned income first, on earned income second. Earned income plus unearned income is going to give you total income. Earned income plus unearned income is going to give you total income. From total income, you will now list frank investment income. From total income, you will list frank investment income. What do we understand by frank investment income? Income that their withholding tax deducted is regarded as a final tax. That income is called frank investment income. In Nigeria, the only frank investment income that we have is dividend. So when we get total income, that dividend that we use under unearned income, we come and less it again. We say less frank investment income. You will less it from total income. At the end of the day, we will get net total income. At the end of the day, when we less frank investment income, if we have frank investment income in that question, we now get net total income. When we get net total income, we can now less tax exemption. We can less tax exempt. What are the tax exempt that we have under personal income tax? What are the tax exempt that we have under personal income tax? National Housing Fund contribution is tax exempt. National Health Insurance Scheme is tax exempt. Life assurance policy, which is the actual premium paid, is also tax exempt. Pension contribution, national pension scheme, is also tax exempt. Gratuity is also tax exempt. In a question, all these 5 tax exempt are mentioned. We may be given in a question. In some questions, they will just give us only 1 tax exempt. In some questions, they may give us two tax exempt. In some questions, they may give us 3. It depends on the question. But we should know that we have like 5 tax exempts: National Housing Fund, National Insurance Scheme, NHIS, pension contribution, life assurance premium, and gratuity. They are all tax exempt. When you less tax exempt from your total income or from your net total income, if you have dividend, we will get net total income. When you less your tax exempt from your net total income, you will get what is called gross income. You will get gross income. Gross income. At the end of the day, when you get your gross income, you can now less your consolidated relief allowance. How do we get consolidated relief allowance? Higher of 200,000 or 1% of gross income plus 20% of gross income. In an exam, they will give us at the back of our exam question. How we get consolidated relief allowance is higher of either 200,000 or 1% of GI. GI means gross income. Anyone that is higher among the two, we take them. We now plus it plus 20% of GI. We plus 20% of GI to it again. 20% of GI, we plus it again. That is how we get our consolidated relief allowance. Let me show that. Consolidated relief allowance. How do we get consolidated relief allowance? Higher of 1% of gross income or 200,000 plus 20% of gross income. That is how we get consolidated relief allowance. That is how we get consolidated relief allowance. Now, when you get your consolidated relief allowance, you minus it from gross income. You will get what is called chargeable income. You will get what is called chargeable income. When you minus your consolidated relief allowance from your gross income, you will get what is called chargeable income. You will get chargeable income. From your chargeable income, you can now compute your tax. How do we compute tax for personal income tax? First 300,000 at 7%, second 300,000 at 11%, next 500,000 at 15%, next 500,000 at 19%, next 1.6 million at 21%. Anything above 3.2 at 24%. When you get your tax under your using your tax table, you now less withholding tax. You less withholding tax that arises from your unearned income. Some of this your unearned income attract withholding tax. You less them. The withholding tax that arise from on your unearned income, you less them from your tax liability. You less them from your tax liability. Now, let's go back to employment income. Let's go back to employment income. What is employment? Under employment income includes salaries, wages, fee, allowance. I've mentioned example of employment income: basic salary, housing allowance, transport allowance, meal allowance, benefit in kind, pension received from old employment, gratuity, bonus. They are all employment income. Now, one of the employment income that we have is called benefit in kind. Benefit in kind. Benefit in kind, they are those expenses incurred by employer on behalf of incurred by employer in provision of benefit to the employee. We can define it in another way, that benefit in kind, they are those benefits received by an employee from employment that does not involve cash payments. Those benefits that you receive that involve cash payment, they are like salary, basic allowance, housing allowance. They are not benefit in kind. But any non-cash benefit that an employee receives from employment, it is called benefit in kind. Any non-cash benefit that an employee receives from employment, it is called benefit in kind. Now, this benefit in kind, we classify, there are three types of benefit in kind under personal income tax. There are three types of benefit in kind under personal income tax. We have accommodation, other assets, and domestic staff. Accommodation,
other assets, and domestic staff. Accommodation, other assets, and domestic staff. If your employer provides you accommodation to be staying, to be residing, they give you accommodation. That accommodation is a benefit in kind. It will be added to your income while computing your personal income tax as an employee. That accommodation given to you by your employer will be added to your income. How do we treat accommodation under benefit in kind in personal income tax? If the employer rent that accommodation is a rented apartment. The annual rent paid by the company, which is your employer on that accommodation, is going to be what we regard as a benefit in kind to you that will be added to your income. If that accommodation is rented by the company normally pay rent every year on that accommodation. That annual rent paid by the company on that accommodation that you are residing as an employee is going to be treated as benefit in kind to you as an employee and is going to be added to your income. It is earned income under employment income. But if the accommodation is owned by the employer, by the company, they are the owner of the accommodation, they just give it as a staff quarter for the employee to be staying. The annual rateable value is going to be treated as the benefit in kind to the employee. We are going to determine the annual rateable value. How much does the value of that apartment worth every year, assuming the company want to rent it out to another party? The amount is what is going to be treated as benefit in kind to that employee, which is part of his income. Let me repeat again. Accommodation under benefit in kind, we can look at it in two ways. Number one is rented apartment. That annual rent paid by the company will be treated as benefit in kind to the employee. Number two is accommodation owned by the company, by the employer. In that case, we are going to determine the rateable value. How much does the value of that building worth if the company want to rent it out to external party? How much will the company be collecting? That amount is what will be treated as benefit in kind to the employee. Another type of benefit in kind, other assets, provision of other assets. If your employer give you other assets like official car, like plant and machinery, like furniture and fitting, how do we get the benefit in kind on other assets? 5% of the cost of purchase of that other asset every year that you, employee, you are using that other asset. 5% of the cost of that other asset every year is what will be treated as benefit in kind to you. 5% of the cost of that other asset every year is what will be treated as benefit in kind to you. Assuming you are given an official car, how much is the cost of that car when they purchase it? Every year that you are using that official car as an employee, 5% of that cost will be treated as benefit in kind to you. It's going to be added as your income that you are going to pay tax on. is going to be added as your income, in which you are going to pay personal income tax on. That is second type of benefit in kind. Another one is provision of domestic staff or support staff. Another type of benefit in kind, provision of domestic staff or support staff. Who are the domestic staff or support staff? Maybe you are the CFO of your company. Your company now give you some domestic staff that will be helping you for your domestic activities. They give you a driver, they give you a cooker, they give you a gardener, they give you a security. You understand? All these people, they are the domestic staff. Once they provide that to you, the salary of that domestic staff that the company pay to the domestic staff every year will be treated as a benefit in kind to you, assuming the domestic staff is not a direct employee of the company. But if the domestic staff is a direct employee of the company that CFO is working, the salary will not be treated as benefit in kind to the person that enjoyed the domestic staff. Let me give an example. You are a CFO of a company. They now give you a cooker or a gardener or a security that will be securing your house. You don't do that. We look at it in two. This security is direct employee. If it is an employee that you, the CFO, you are working.
So your voice is breaking.
Okay.
We can hear you.
We can't hear you, sir.
It's still, but you can hear me now. Hello.
Yes, sir.
Hello. Okay, better.
Thank
you. On domestic staff, we look at domestic staff in two angles. Domestic staff, we are looking at them in what? In two angles. Number one is, if the domestic staff is not direct employee of the company you are working for, they just employ the domestic staff purposely because of you, the CFO, for example. The salary paid to that domestic staff will be treated as a benefit in kind to you that you enjoy this domestic staff, the CFO. I'm giving an example. Maybe you are a CFO, then I'll give you a domestic staff. If the domestic staff is not direct employee of the company that you are working for, that salary paid to that domestic staff every year or to the outsourcing company that employ the domestic staff will be treated as a benefit in kind to you. But if the domestic staff is a direct employee of the company that you are working for, the salary paid to the domestic staff cannot be treated as benefit in kind to you. In that case, the domestic staff will not be added as part of your benefit in kind. It will not be added to your income. But if the domestic staff is not direct employee of the company, the salary or allowance paid to that domestic staff will be treated as an income to you. And that income will be called benefit in kind. However, there are some benefits that employer provide to the employee that cannot be treated as a benefit in kind. We have mentioned 3 benefits that employer will provide to the employee that will be treated as the benefit in kind. What are those benefits we mentioned? What are those 3 benefits that we mentioned that employer give employee that will be treated as benefit in kind?
Domestic staff,
Okay,
official car,
accommodation, other asset, under other asset, official car. You understand? Those are the 3 benefits. Provision of other assets. Example, official car, plant and machinery. Provision of accommodation and provision of domestic staff. However, there are some benefits that employee receive from his company or cannot be treated as benefit in kind. What are those benefits? Provision of voucher, provision of new voucher,
your network is bad.
provision of meal voucher, or provision of lunch voucher. Your employer, they give you a lunch every day in your company. Your employer give you a lunch every day. Your employer, they give you a lunch every day. That lunch given to you cannot be treated as benefit in kind. Lunch voucher, the lunch meal given to you by your employer in your company every day cannot be treated as benefit in kind though. Another benefit given by employer to the employee that will not be treated as benefit in kind is provision of uniform, or protective protective jackets. If employer give you a uniform or protective jacket, that cannot be treated as benefit in kind. That cannot be treated as benefit in kind. Relocation allowance. Relocation allowance. Relocation allowance. If employer give you a relocation allowance, why you want to relocate to the other branch, they transfer you to other branch. They now help you to transport your belongings from that your old branch to other branch states. That money that you pay for the transport, they now said they will give you back. You understand? That one cannot be treated as benefit in kind. So all those are the benefits provided by employer that will not be treated as benefits in kind. Now, let's look at type of employment. Employment. What is employment? Employment simply means a situation whereby an employee will provide certain service for the reward of simply means a contract of service where employee provides services. In Nigeria, we are under Nigeria employment because the service that we render will be carried out in Nigeria. But why we are our company transfer us to other country to go and work, that has turned to what? Foreign employment. We are working in Nigeria. They now transfer us from Nigeria. They transfer us to other country to go and work there. We have subsidiary or branches in other country. They now transfer us to go and work in that other country. That means we are under foreign employment because that duties that we perform is carried out outside Nigeria. Nigeria employment is an employment in which the duties carried out by the employee is carried out within Nigeria. But an employment in which the duty is carried out outside Nigeria is called foreign employment. Vocation. Vocation simply means a profession that involves learning of skills. Vocation means a profession that involves learning of what? Skills. Learning of skills. All those artisans, fashion designer, welder, electrician, bricklayer, they are under vocation. Profession. Profession simply means rendering of specialized service through training and ethics. When you are trained to render specialized service, maybe you are an auditor or you are a lawyer, you are under profession because you are being trained to render specialized service. That specialized service follows some ethical standards. That is profession. Now, still under employment. Under the employment, Nigeria employment, the employment carried out in Nigeria, the service that's carried out in Nigeria, we can divide Nigeria employment into two. Nigeria employment, we can divide it into two. Nigeria employment, we can divide it into two. Nigeria employment can be divided into two. Contract of employment and contract for employment. Nigeria employment, the employment in which the duty is carried out within Nigeria, we can divide it into two. Contract of employment and contract for employment. Contract of employment are those employments Contract of employment is an agreement between employer and employee which is set out their employment rights, responsibility, duties to the terms of employment. Contract of employment simply means an employment in which the reward is in form of salaries and wages. Contract of employment simply means an employment in which the reward is in form of what? Salaries and wages. But contract for employment are those employment in which the reward is in form of profits. In contract of employment, it's a full-time job. But contract for employment is a part-time job. Let's differentiate between contract of employment and contract for employment. Between employment and contract for employment, differences is contract of employment, we remuneration, wages. An individual contract we earn remuneration, which is salary. An individual contract of employment an individual contract of employment under contract for employment is going to earn number one differences, and under contract of employment earn remuneration, which is salaries and wages. Why an individual under contract employment earn profits. Another difference is contract of employment is assessed to tax on, why contract for employment is assessed to tax on preceding year basis. Contract of employment is assessed to tax on actual year basis. Why contract for employment is assessed to tax on preceding year basis. Another difference, contract for employment is a full-time service. Why contract for employment is a part-time service. Contract of employment is a full-time service. Why contract for employment is a part-time service. Under contract of employment, they are not expected to register for VAT, but on contract for employment, the individual is expected to register for VAT. For employment, they are not expected. Contract of employment is not expected for VAT. Why contract of employment is expected to for VAT? are looking at difference between contract of employment and contracts for employment. Look at differences between contract of employment and contract for employment. And under contract of employment is not expected to register for VAT. Why individual under contract of employment expected to register for VAT? Contract of employment can be terminated through labor law. Why contract of employment can be terminated through labor law? Why contract for employment can only be terminated based on agreed service? Once they finish rendering the service, it's automatic terminated. What we mean by that is, for contract of employment, which is a full-time service, you cannot just terminate the employment. You have to follow the labor law. But in the contract for employment, you can terminate it anytime they finish rendering the service. Do we understand? Do we understand? So there are two types of employment we have. We have Nigeria employment and foreign employment. Nigeria employment simply means those employment in which the duties is carried out within Nigeria. Why foreign employment means those employment in which their duties is carried out outside Nigeria. Nigeria employment, we now classify it into two. We divide Nigeria employment into two: contract of employment and contract for employment. We said contract of employment is the one that earn profit, wages and salary, remuneration. Why contract for employment earn profit? That is number one difference. Contract of employment is a full-time service. Why contract for employment is a part-time service? Contract of employment is assessed to tax on actual year basis. Why contract for employment is assessed to tax on preceding year basis? Another difference: contract of employment is not required to register for VAT. Why contract for employment is required to register for VAT? The last one is under contract of employment. The contract can be terminated through labor law. But under contract for employment, the contract cannot be terminated through labor law. So those are the major difference between contract of employment and contract for employment. So that is what we need to know on this. Now, the next thing that we need to know is what are the income exempted from personal income tax? What are those income that if you receive it is going to be exempted from personal income tax? What are those income exempted from personal income tax? Income exempted from personal income tax. Number one income exempted from personal income tax is reimbursable expenses paid to the employee. Reimbursable expenses paid to the employee is exempted from personal income tax. Another income exempted from personal income tax is compensation for loss of office. When they give employee a compensation for loss of office, that compensation for loss of office will be exempted from personal income tax. Medical expenses paid on behalf of employee is also exempted from personal income tax. Dividend received by employee or individual will also be exempted from personal income tax. Interest on government securities. Interest on government securities too will also be exempted from personal income tax. Interest on foreign loan received exempted from personal income tax. So those are the income exempted from personal income tax. Now we have looked at that. What we need to do now, let's go and look at a question on personal income tax. Let's go and look at a question on personal income tax. Let's look at a question on personal income tax. Before we look at a question, so let's go on a 5-minute break. Let's go on 5-minute break. So once we resume the break, we look at a question on personal income.
Okay, we are back. Personal income tax. We can now look at a question on personal income tax. Let's look at examinable question 1. Examinable question 1. Who can read for us? Examinable question 1. Mr. Willie was employed by Zenon Bank Limited as head of banking operation, effective from effective from June 1st, 2021. The detail of his salary are as follows. Basic salary per annum, 48 million. Housing allowance, 12 million. Transport allowance, 2 million. Utility allowance, 800,000. Meal allowance, 500,000. Leave allowance, 4,800,000. Clothing allowance, 2 million naira. Mr. Willie was provided with official car. The cost of the car is 7.5 million. He was also provided with a driver and a personal assistant, which were paid 300,000 and 500,000 per annum. Prior to joining Zenon Bank, Mr. Willie was on an annual salary of 32 million naira while working with Carbon Bank PLC. He resigned from the bank effective from what? May 31st, 2021. Additional information. Mr. Willie was married with 6 children. All are of school age. He maintained his aged parents, which live with him in Lagos. He paid annual life assurance premium of how much? 3 million. His employer deducted and remit on his behalf a mandatory deduction of 4,900,000 and 1,166,667 for NHF and pension contribution. He also paid NHIS premium of 350 in 2021 to health service provider to provide medical cover for himself and his family. You are required to compute the tax liability of Mr. Willie
for the relevant year of assessment. We are asked to compute tax liability. Mr. Willie is an individual. What type of tax Mr. Willie will pay?
Personal income tax.
Personal income tax. Like I said, look at the format I gave under personal income tax. Look at the format. This is the format we are going to follow while computing this tax for Mr. Willie. This is the format we are going to follow. Now, look at the income paid to Mr. Willie. This income paid to Mr. Willie, what type of income? Please try to put your audio. Please try to mute your audio. What type of income paid to this Mr. Willie receive? Where does Mr. Willie receive the income? Who can tell me?
Earned income.
Is what?
Earned income.
Earned income. And under earned income, what type of income do we call this type of income received by Mr. Willie?
Employment.
Employment income. All the income received by Mr. Willie is coming from employment income, is earned income. Employment income is going to be assessed on what basis?
Actual year basis.
Actual year basis. That means in our tax computation, which year of assessment will be our year of assessment?
2021.
2021. Thank you very much, my brother. All this income received by Mr. Willie is an employment income. You know, under this format I gave you, we have earned income. Under earned income, we have employment income, we have trading income. Salaries, transport allowance, housing allowance, utility allowance, benefit in kind, they are all employment income. Only trading income that we have, profits from business after capital allowance. We don't have trading income in this question. So there will be access to tax on actual year basis. Actual year basis. Now, Mr. Willie, in this question, he worked with how many banks in this year of assessment? How many banks he worked with?
2 banks.
2 banks. First and foremost, that means Mr. Willie has old employment and new employment. What is the name of new place that Mr. Willie is working?
Xenon.
Xenon. He previously worked in where?
Carbon.
Carbon. Carbon is old employment. Why Xenon is what? New employment. How many months does Mr. Willie work with Xenon in a year? How many months? How many months?
Is 6 months. 6 months.
6 months.
Yes.
My people, it's 7 months. Oh.
7 months. 7 months.
Okay, yeah, 7 months. Yeah, 7 months.
All this income giving, this basic salary is for how many months?
12 months.
12 months. That means you are going to prorate it. We need only for 7 months. Because he did not work for 12 months. Housing allowance too. We need only for 7 months. Transport allowance too. We need for 7 months. All this employment he collected from the new employment, all this income that he collected from the new employment is going to be based on 7 months. We are giving for 12 months. We are going to prorate them. That means we are going to use 7/12 times 48 million. 7/12 times 12 million. 7/12 times 2 million. 7/12 times 800,000. 7/12 times 500,000. 7/12 times 4,800,000. That is for the new employment. For the old employment, what is the income he collected from the old employment? Annual salary of how much?
32 million.
32 million. How many months does he work in the old employment?
5.
5 months. That means this 32 million is for a whole year annual salary for 1 year. That means this one we're going to prorate it to what? We are going to prorate it to 5 months,
5 of
which is 5/12. Abi?
yes.
So let's go to the solution. Mr. Willie, computation of tax liability for 2021 year of assessment, because it's an employment income. All this income is for 2021, and an employment income is assessed to tax on actual year basis. So our year of assessment will be 2021. Basic salary, 28 million. We divide his earned income into two: new employment and old employment. The income is collecting from the new employment. Number one is what? From the new employment. What is the number one income he collected from the new employment? Basic salary. You can see that. This is for 12 months. For us to get 7 months, 7/12 times 48 million, we are going to get 28 million. Housing allowance for 7 months too, we are going to get 7 million. That is 7/12 times 12 million. You will get 7 million. Do you understand? Do you understand?
Yes, sir.
Yeah.
Transport allowance too. How much is transport allowance for a year for the new employment? 2 million. 7/12 times 2 million. You are going to get 1,166,667. Utility allowance. How much in a year? How much is the utility allowance in a year? 800,000. 800,000. 7/12 times 800,000. How much are we going to get? $466,667. We do that for meal allowance. We do that for leave allowance. We do that for clothing allowance too. All of them with 7 months. How do we get our benefits in kind? Let's go and look at the question. How do we get our benefits in kind? Let's look at question. How we get our benefits in kind. We know how we get this from basic salary to clothing allowance. It's 7/12 of what we are giving in the question. All this we are giving. After that, they said Mr. Willie was provided with official car. They gave her what? Official car. That new employment, they gave her official car. Official car is what type of income?
Benefit in kind.
Benefit in kind. How do we get the benefit in kind when we are giving official car?
5% of the cost.
So
5% of
5% of
Hello. Please, I don't have this question. I've been trying to look for it.
is in the, I've sent the material now. Personal income tax.
Okay.
I've sent the material last week. Hope if you check your group chat, the material is there. The lecture material is there. Now, 5% of how much?
7.5.
5% of the cost of the vehicle.
Give us
375,000.
who gave her the official car? Who gave her the official car?
Zenon Bank.
Then
Zenith Bank. How many months does he work in Zenith Bank?
7 months.
That means 5% of 7.5 times 7 over what? Over 12. You know, 5% of 7.5 you get for 1 year. Since he did not work for 1 year, he worked for 7 months. 7 over 12. So 5% of 7.5 times 7 over 12. What do we get?
218,750.
2-1. Can you see that?
218,750.
Look at the solution. Benefit in kind. Official car. Can you see how we get that? Under his new employment income. Can you see how we get that?
Yes, sir.
Now, what other benefits is he giving? What other benefit does he receive from Zenith Bank? He was also provided what? He was
A
also
driver
provided a driver
and a private personal
and
assistant.
private personal assistant. And they were paid what? 300
300,000.
and 500,000. Under benefits in kind, these some people, what do we call them? A driver, personal assistant, under benefits in kind.
Domestic staff.
Domestic staff. This is what was paid to them in a year. Who provide them to him? Who provide them to Mr. Willie?
Zeno.
Zenon Bank.
How many months does he work in Zenon Bank?
7 months.
That means when we want to write this as benefit in kind to Mr. Willie, we are not going to use for 12 months. We are going to use for how many months? 7 months. So for us to get benefit in kind, driver salary, 7/12 times that driver salary.
175,000.
That is 175,000.
Yes, sir.
This is personal assistant, 7/12 times 500,000.
500,000. 500 times 7. 291,666.
That is how we get
Approximately 667.
291,667. Do you
Yeah.
understand? Do you
Yes,
understand?
sir.
That is his new employment. We now go old employment. Old employment. Old what? Employment. What salary does this man receive from old employment? What salary does this man receive from old employment?
32 million.
32 million. That 32 million is going to be prorated to how many months?
5 months.
5 months. Because he worked in the old employment for 5 months. So 5/12 times 32 million. It will give us what? 13 million. 3. Do you understand how we get that?
Yes, sir.
Any other income that Mr. Willie received, any other income that he received, he does not have any other income. In this question, does Mr. Willie have unearned income? Look at unearned income. Does he receive rent from his property? Does he receive interest? Does he receive dividend? Do we have unearned income in this question? No. So our unearned income is dash. Our unearned income, dash. We have get earned income, unearned income, dash. Earned income plus unearned income, according to the format, what is it going to give you?
Total income.
Total income. Let me take it to the format again, for those of you that don't understand. Earned income plus unearned income. If you add the two of them together, it will give you total income. It will give you total income. Look at it. Earned income plus unearned income. It will give you what? Total income. So we don't have unearned income in this question. Our earned income plus unearned income, what is it going to give us? What will be our total income? We sum everything together. We sum both new employment and old employment. Everything, we sum them together. That is our total income. That is 54,910,417. After we get total income, what do we do according to the format? After we get total income, what do we do? We less frank investment income, which is dividend. Do we have dividend in this question? No. There is no dividend. That means we go to tax exempt. What are the tax exempt? National Housing Fund, National Health Insurance Scheme, Life Assurance Policy, pension. In this question, do we have any tax exempt? Do we have tax exempt in this question?
Yes, sir.
Yes.
What are the tax exempt? You can show me.
Life assurance, NHF, NHIF.
Life assurance, annual life assurance premium, 3 million. They also have NHF. They also have pension. All these are the tax exempt. Let's go to the solution. We go and less tax exempt. Life assurance policy. That is the premium, 3 million. NHF, we are giving. Pension, we are giving for. We are also giving NHIS. NHIS was also given. NHIS was also given. We less all those tax exempt. When we less tax exempt from total income, what do we get?
Chargeable income.
No. Tax exempt. We less it from total income. What do we get?
Gross income.
Gross income. Look at the sum of tax exempt. The total tax exempt that we have is 9,416,667. When we less it from total income, we get gross income. Our gross income is going to be 45,750. 45,493,750. That is our gross income. According to the format, after you get gross income, what do you less?
Consolidated relief allowance.
You less CRA, which is the tax relief. CRA. How do we get CRA? What did I say about consolidated relief allowance? Who can remind me?
Higher of 200,000 or 1% of gross income.
Of
I said to your CRA. You have 200,000, 1% of GI. Which one is higher? Take it. You now plus it plus 20% of GI. In this question, which one is higher? Is it 200,000 or 1% of GI?
1%.
1% of what?
Of GI.
1% of 45,493,750. It will give us what?
455,937.5.
That means it is higher than 200,000. Assuming it's lower than 200,000, this place that I paint, assuming it's lower than 200,000, what am I going to put here?
200,000.
200,000. I now say plus 20% of GI, 20% of 45,493,750. What is it going to give us? 9,098,750. You now plus the two together. You plus them together. When you plus the two together, you are going to get 99,553,687. You are going to less it from gross income. When you less it from gross income, you will get your what? When you less CRS from gross income, what do you?
Chargeable income.
So in question, my chargeable income is 35,940,006. I will now apply the tax rate. I will apply tax rate. Income. I will apply the tax rate. Income. How to get the tax rate? The tax rate we know it should be given to us in question. First 300,000 at 7%. How much is it going to give us? I want to compute my tax liability. First 300,000 at 7% is going to give us how much?
21,000 naira.
Second 300,000 at 11%, it will give us what?
33,000.
Next 500,000 at what? 15% is going to give us what?
75,000.
Next 500,000 at 19%, it will give us what?
95,000 naira.
Can we still go ahead?
Yes.
Look at the chargeable income. Next 1.6 as 21%.
336,000.
After you get to 336,000, how much have you deducted so far from the chargeable income? When you are computing the tax liability, how much have you deducted so far?
3.2 million.
3.2 million. That is what we have deducted so far from the chargeable income. 3.2 million. Now, you will not say you minus 3.2 million. You will minus it from where? From 35,940,062. What will be the balance? I did not compute the tax liability. I did not complete it in this my question. I don't know. I have to go and I will do the correction. What I'm saying is this 3.2 million, you will minus it from 35,940,062. What will be the balance?
32,740.
Eh?
Sorry, 32.
32,740,062.
That one will be at what percentage?
24.
At 24%. At anything above 3.2 is going to be at what? 24%. That means you still need to do that one. I will send the correction. You write that amount. 32 something, 32 what? 32 what?
32,740,062.
32,740. Abi?
Yes, sir.
0 what?
064.
064 at
24%.
at
That's 24%.
at 24%. So the amount that you give, that it give you, you will come and write it under 336. Do you understand? You come and write it under 336. Any amount you give it. At the end of the day, you will now sum all of them, all the tasks from 21 million. 21 million plus 33 plus 75 plus 95 plus 336 plus that one that he will give you, the last one, you will sum everything. That is your total tax liability. You are done. Any question on this?
What if the suggestion, sir? What if you go straight forward to just bid at 24% instead of doing first 7%, first second 11%?
Madam, this is how they put your salary. Your tax you pay, your personal cost in your salary every month. This is the law. Tax is law. Tax, there's no what if. Tax is not a performance management. I mean, what do you call them? Tax is dynamic. This tax liability is stated according to the Personal Income Tax Act. That is how the law say we should compute it. We cannot do anything otherwise that is not stated in the law. Do you understand? We cannot do anything otherwise that is not stated in the law. According to the law, that is how they ask us to compute personal income tax. So there is no what if in taxation. What is stated in the law, and tax is dynamic. This is what we are using presently. In the next 2 years, it may do what? It may change.
Hello.
It may change in the next 2 years. Tax is dynamic. It's different from any other courses that even the formula that they have been using in 1960, 1980. Same break-even point.
Hello, sir.
So, any other question?
Yeah, so the computation, that's 32,740,064 at 24% is, the answer is 7,857,615. So will that be the final calculation?
You add everything together. You add it with the old one we have been doing. Do you understand? Do you understand? So, ladies and gentlemen, in the evening, from 8 o'clock or 8:30, we will continue from this personal income tax today, so that we finish personal income tax. We will solve two or three more questions today. So our class will continue in the evening. 8:30 p.m. we will do to 9:30 p.m. We don't have time again.
Please, sir, we have class. Bye.
Oh, you have a PSAP. Hey, what do we do?
Yes, sir.
What do we do? Madam, we are going to do that tomorrow. 8:30 p.m. Tonight, we must take time so that we finish personal income tax. Next week, we do partnership. Please, tomorrow, 8:30 p.m. to 9:30 p.m.
Okay,
So
sir.
thank you very much.
Thank you, sir.